All right. Well, we are live and we're just working on one quick thing on the tech front. But this week we have, let me get back to this before we do that. We have a new panelist here. We have Barbara Friedberg, the famous Barbara Friedberg.
Hello, everybody. So happy to be here chatting the strong dollar.
Well, excited to have Barb on this week because Barb is an expert in all things finance, and this is going to be a fun episode. So let's take it away here. So give me half a second. Okay. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will once again be your host. Today we have our very own Barbara Friedberg. Hey, Barb.
Hey, Kirk. Happy to be here.
Great. So if you like the show this week, please do a solid and subscribe, like, or comment on the medium of your choice. We love you either way, but we love you more if you love us back. So today we are going to be talking about the strong dollar. So Barb, I know you've, before we kind of dive right in, I know you have a background as a portfolio manager and you're just like a fountain of wisdom and all other things finance. But we talk about the strong dollar. What does that mean to you? What kind of impact should people
Okay,
look at?
let me start with a story because I just returned from Canada. And believe it or not, even though they speak English, it is a foreign country. I've been to Canada many times over my life, and never have I been so happy spending my money there because the US dollar is very strong. It is actually at a near-term high, which means that the US dollar buys more foreign dollars when it is stronger. So, for example, when I spent $1 in Canada of Canadian money, I was only spending 75 cents of US money. So that was great for us as US citizens. When our dollar is strong, it makes foreign goods and services cheaper. It makes traveling abroad cheaper. And conversely, when the dollar is strong, it makes our goods and services more expensive for international people, international companies. So this can hurt the globe. Even though it's great for us in America, we do care about the others around the globe and their economic impact.
So I think that's a good starting point. And I want to talk about a few things this week because I think if you look at what's going on in the world, there's a lot of factors that come into play. And people are mostly focused on interest rates, but they're not focused on the US dollar. They're not focused on currencies. Why? Well, if you live in the US, you never worry about currencies because people around here generally don't travel outside the country. We don't know there's a world outside the US. It's just somewhere else, right? It's not US, right? I saw a good meme about Russia, and it had all the countries around Russia, and it said Russia for the Russia part, and everything else said not Russia. And I think it was a meme to tell Russia that
Yeah,
this is not Russia.
we're kind of horrible at this, Kirk. We are way too insular in the US, and we really forget that we are only a small part of a bigger world.
Correct. And so I think probably before we start, I'm going to have to name this the Einstein episode because really everything's relative. And if you look at what we're going to be talking about today, it's going to be things relative to other things. So when we talk about currencies, as Barb was talking about with Canada, the Canadian dollar compares to the US dollar. So one is relative to the other. Now this is weird because we're used to the dollar, we only know the dollar. So we're looking at the Canadian dollar and saying, "Wow, the Canadian dollar is getting cheaper." Well, is it? Or is the US dollar getting stronger? We don't know because both of them are moving, right? They're both moving prices. So you could hypothesize which one's moving and why, but really they're relative to each other and they're both moving. So it becomes a little bit challenging to identify that. Now, there is one thing which we're going to get to, which is gold. So gold doesn't move. It doesn't change. Gold is a fixed point, which you can relate to a currency and say, oh, is the US dollar going up or down compared to gold? is the Japanese yen going up or down compared to gold. So that is something that you look at gold and say, well, actually, gold is going up and down in price, but that's actually not the case. Gold is where it is. The US dollar is going up and down in price in comparison. So today we're going to be talking about how each currency relates to gold because it is a fixed point that you can compare other things to. Now, the other problem with the dollar is if you look at international currencies, the dollar is a basket of. They look at the dollar basket. It's each one is each other currency has a percentage, and if you look at that factor, that's how they're comparing it. It's not just one currency; they're looking at against a basket of currencies. So it's not necessarily a fair comparison because why is the euro more important than the yen or any others? So we're going to use gold today to simplify it for everybody. Now, if you look at where the dollar has been, the dollar's up. What's it up like 17% this year so far, Barb? I mean,
it's close to 22% as of
wow.
today. And again, a 20-year high.
So if you were looking at your portfolio and you're wondering, why am I losing so much money? Think about the dollar and think about how much more you could be making if you were in the dollar. It's probably the only thing outside of oil that is up this year. I say this
Commodities are up too.
Commodities, yes. Not all commodities, though.
Yeah,
I mean, especially
some dollar-denominated commodities.
Dollar-denominated, yes. But, oil, natural gas, energy is up. Not all commodities, but definitely energy is up. But, a lot of people, we hear this a lot, and this really bugs me. So there are these perma bears out there that think the world's going to end, the dollar's going to go to zero, and we're going to have hyperinflation tomorrow. This is a very common theme, especially for newsletter publishers, because they scare the pants off people and they say, oh, I got to find out what's going on and what can I do to save myself from the US going bankrupt. Well, the US dollar may be the worst currency out there, except for all the rest, right? And I think this is the part that people don't tell you. They say, oh yeah, the US dollar, it's a mess, right? And if you think about it, we have high inflation. We are if you look at interest rates, right? We have higher interest rates than everybody else. We have I don't know if we have higher inflation, but we have moderately high inflation compared to everybody else. Our currency is more stable. We're financially irresponsible. We have a lot of debt and we have high inflation. Yeah, so is everybody else, right? Like if you look at how bad the US dollar is and all the critiques of the dollar, everybody else has the same problems. I mean, Turkey has 130% inflation rate this year. Thankfully, we don't have that. It's only 8.3. But while our government's finances are a mess, so is everybody else's. There's a reason inflation is high around the globe, and there's a reason that it probably won't go away in the near future. So, I want to talk about this one really important question, which is, what does a higher dollar mean to the markets? So, Barb, what are your thoughts?
That is not as easy a question as it sounds.
Why not? Okay. Come on.
Well, because first of all, we talk about the markets. We're talking about individual companies within the U.S. international sphere. And many of our listed companies trade all over the world. So if they're a U.S. company, foreign goods are cheaper for them. They can buy them. And that you would think would raise their value. But when you combine that with higher interest rates, which make debt more expensive for them, that's a negative impact. So it's like, what's causing all this? And what was your question? Anyhow, I'm like going off on a tangent. I forgot what you asked me.
That's all right. It's Friday, Barb. I fully forgive you.
Thank you.
And this is a live event. We don't have the luxury of editing today, so we're going to have a lot of fun.
Okay, well, listeners, hey, I'm here.
Good for you. I'm glad. In about 10 years, you may not be. We all may be cyborgs. So the question, I've got a few questions here. The first one is, what does a higher dollar mean to the markets, more specifically asset prices?
Okay, well, you may think, okay, the dollar has gone up, but let's back up. Why is the dollar strong? Okay. And there can be, it's again, not one reason. So we have seen inflation go up a lot. And inflation, in just plain terms, means that there are fewer dollars chasing, there are fewer dollars chasing more goods. So the prices are going to go up. The Federal Reserve, which controls the monetary policy and tries to keep the US economy stable, is fighting inflation because we don't like inflation. Because inflation means the orange that you bought at the store for $1 yesterday costs $1.50 tomorrow. And so the inflation rate is going up because more people are chasing fewer goods. And part of that is attributed to the supply chain problems that were started during COVID that stopped the global economies from producing as much as we needed in the US and across the globe. So the Federal Reserve said, okay, we'll raise interest rates because as interest rates go up, people aren't going to borrow more and you're not going to spend as much. Yes, that should cause inflation to fall a bit. And so the equilibrium between demand and supply will come closer. So the dollar is strong because the US is raising interest rates. And as Kirk mentioned, the economy is relatively stronger in the US than it is across the globe. So, what does that mean for asset prices? Well, if you see interest rates going up, asset prices don't like that because most companies base their growth a proportion on borrowing and on debt. And when debt is cheaper, interest rates are lower, they can borrow more money at cheaper costs, they can increase their research and development, and they can grow more quickly. And a fast growing company will lead to higher asset prices. A slower growing company will lead to lower asset prices. So, those are some of the contributors to how the dollar is interacting with inflation, which is interacting with debt, which is causing global markets to fall. There's another factor that is causing global markets to fall, which is the war in Russia and the Ukraine. And the world doesn't like uncertainty. That is really uncertain, so it's scaring the global markets. And additionally, the Ukraine is a huge supplier of grain and other things across the world. And when their supply is cut off, there is less of that. And that serves to increase inflation, which will hurt asset prices.
Yeah, so I think you said a lot of great things there, Barb. I'm going to try to narrow down on a few of them because I think
I
there's
hope so because I felt like I was all over the place.
no. You were great, Barb. I have no complaints. So I think that if you look at why what does a higher dollar mean to asset prices and the markets? So here's the thing: why do we have a stronger dollar? And there's many reasons for this. So part of this is speculation because nobody really knows. It's like saying, why did Apple go up today? Why did gold go down? If anybody gives you an answer, it's all BS. Nobody knows. I mean, you could give multiple different answers, and we are human nature dictates that we need an answer for a question. We can't just let a question go unanswered because it puts a void out there and we feel unsettled. So we feel like we need an answer, which is why the news tries to give us answers every day to questions that they don't have answers to. But their job is to provide you answers. As an example, I think it was back in 2011 or 12 when gold, Barb, we get some beeping in the background. Let's see your
Oh,
show.
let me mute. My trash
Okay.
is being picked up.
Oh,
Sorry, guys.
all right.
Trash day.
Thanks. So if you look back, I think it was 2011 or 12 when gold crashed. It was on, oddly enough, it was on tax day. It was on April 15th, and I saw it. I was watching it, and I saw it happen. And the news came out and said, "Oh, it was a fat finger trade, or it was a deliberate attempt," or there were like 5 different reasons. None of them were right, because in order to actually know why it happened, you had to be in the inner workings of the beast. You had to be on an institutional trading desk, watch somebody fat finger a trade, or know that somebody was trying to manipulate the price lower, or whatever it was. No one knows, but we all speculate and we all think we have an answer that makes sense because it makes us feel comfortable. So I only state that because we really don't know why there's a stronger dollar. Now we can speculate, and I think it makes sense. So if you look at why would a currency become stronger? Well, it's in many ways it's a sign of confidence. And you look at the US and you're like, our country's a mess. Why would people be confident in the US dollar? Yeah, we're a mess, but we're still better than most other countries. So if you look at the mess we have, it's still in better shape than a lot of countries. So, things that are impacted, balance sheets, right? What's our government's balance sheet? Is it a mess? Sure, but look at Japan. Japan's a bigger mess. I mean, their debt to GDP is astronomical. Okay, that's one thing. You look at tax collections. You look at interest rates. What are the interest rates in the U.S.? Well, they're a heck of a lot higher than they are in many other countries. So if you look at interest rates right now, I was just pulling some up this morning. The 10-year is in line with the Aussie, the Australian dollar. But if you look, and the UK is around 4, Germany's 2.5, Japan is 25 basis points, China's 2.75, and the US 10-year is 4.25. So we're one of the highest interest rates of developed countries, which means that people want to send money here, right? Or there could be because there's opportunity, or it could be because there's no opportunity elsewhere. There's so many reasons why the dollar gets stronger, but effectively what it means is people have more confidence in the dollar and they want to own dollars. Now, at some point, that's going to reverse. At some point, people are going to say, hey, there's better opportunity over in, I can't even think of a place where I could think there'd be better opportunity right now, but let's just say there is, right? And there's better opportunity elsewhere, then the dollar will decline. Or it could be because people, instead of owning dollars, maybe it's because they want to sell their dollars and buy stocks or gold or bonds or whatever it is. So there's so many different moving pieces. There's never a single reason why something is moving in one direction over another. Now, what does this mean for the markets and asset prices? This is the ultimate question. Well, here's what it means. It means that if the dollar is stronger, it pushes pressure on asset prices lower. So the stronger a dollar gets, it just means there's more pressure pushing down asset prices. Does it mean that asset prices are going to keep going down as the dollar goes up? No. Every time that people they're looking for an argument as to why their thesis on where things are going to go is correct. They look at the dollar and say, well, the dollar is going down. That means gold should go up, or vice versa. Maybe. I mean, if you look at the times that I've heard that, it almost never happens when people say it, but there is an impact. So it's not the only impact. It's rarely the only impact, but there is influence. So you have to look at it that way. It's not the reason, but there is influence. So the stronger dollar will influence gold lower. And if you looked at gold, we have high inflation. Shouldn't gold be doing great? Yes, it should. It should be doing a lot better. Is it? Not necessarily, but maybe relative to other things. But a strong dollar, since I think there are probably some international people listening here, or I know there are, they may have a different impact. But from a dollar standpoint, what it means is I'm buying gold by giving them US dollars and getting gold back, which means that it's a dollar to gold comparison. So as the dollar gets stronger, it means the price of gold goes down in comparison. So I know it's hard as somebody in a country to see this happen. In a foreign country, it's easy, but here it's harder to visualize this, especially in the U.S. since we don't exchange our currency like the Europeans have done over decades. So it's something just to be aware of. So it means that it's going to put downward pressure on asset prices. As it means also that other countries, people in foreign countries, are looking to send their cash here because it's safer. So as long as as that dynamic is in play, it means the stronger dollar is the theme. Now we're going to show you, if you check out our podcast when it comes out on Wednesday, which is this episode, we're going to have lots of charts to show you. If I can, I'm going to show you some here, but I'm still new to live stream, so I'm just getting the thinking here. But I do want to get back to the impact of the stronger dollar. So, Barb, you used to be a portfolio manager, and I'm sure you looked at lots of stocks domestically and globally. What's the global impact of a stronger dollar? What does that mean for other countries, other stock markets? Like, what are the pros and cons of a higher dollar internationally?
Internationally, it's not good for the global economy because just as for the US economy, every other country's goods and services are cheaper. What a strong dollar means for the rest of the world when they are trading with the US, and the US isn't the only trading partner, but we cover nearly half of the global markets in terms of the stock markets. Everything is more expensive for them. So that really hurts other countries who are trading with us because that makes everything that they buy with us more expensive. Additionally, there's another side that we haven't tapped on. International commodities are predominantly priced in the US dollar. And so the stronger dollar leads to higher imported inflation for the rest of the world. And so what this does is it creates a global monetary policy where the global countries are also going to be raising their prices. But there's another factor in terms of global debt. Almost half of the cross-border loans, the international debt, is denominated in US dollars. So what that means is now that the international community who's borrowed money has to pay that money back with for a higher price. It costs them more to pay the money back with a stronger dollar. And in worst case scenario, if they can't afford to make their debt payments, that leads to debt downgrading. It can also lead to bankruptcies, which, as we saw in the 2008 global financial crisis, can lead to a worsening asset prices and global stocks. And right now, we are in a reverse of a sweet spot, which means everything is down. International stocks are down. US stocks are down. Bonds are down because interest rates are rising. That causes the value of bonds to go down. Now, look, there are pockets of assets that are going up. Great. Good luck shushing those out and finding them. But you may be thinking, and I want to bring this to a practical level because I'm always thinking about listeners, and so many people, really smart people, are coming to me and going, should I change my asset allocation? Is my portfolio going to survive? What's going to happen? Part of asset prices are driven not only by facts, they're driven by opinions. And as Kirk said, we don't even know what is sometimes driving asset prices. But additionally, markets are not, they're driven by psychology. And both US and global markets are driven by future expectations. So right now, both in the US and across the globe, there are fears that we will go into a US and a global recession. And what that means in plain English is lower growth. Typically, they say 2 quarters of lower GDP growth. And recessions are only determined after the fact. But if markets are thinking, okay, we're going into a recession, and global markets are thinking the dollar is going to keep rising, so trading with the US is going to be more expensive. Our debt payments are going to be higher. That's going to push asset prices down as well. So we are riveted in fear right now. The psychology of the markets is driving a lot of fear. But Kirk, I want to ask you, is this going to last forever? And what are the things that are going to change this fear in these falling markets? Because the projections, the lower dollar, the lower international currencies values against the dollar, they're spooking us. But how does the future look? And how should people be thinking, given the current environment, what might happen in the future?
Yeah, I want to address that, and then I want to go to some of the charts since I figured out how to use this newfangled technology.
Good
Um,
job.
so I think here's something to think about, and I might as well start sharing the screen because I think it's a good starting point. So if you look at this screen, I have a chart of the U.S. dollar, and the top one is the last 5 years. The bottom one is the last looks like 40 years or 50 years. Now, if you look at the chart, and you can forget what the chart is. Don't worry about the fact that it's a dollar. But if you look at the chart and you see, wow, it looks really high relative to history, you'd be correct. It is relatively high compared to history. However, if you compare the fact that it obviously doesn't stay there very long, there's a reason for that, because the best recipe for high prices is high prices. The best recipe for low prices is low prices. It's what we call economics and capitalism. It's when you have a free market, if prices are too low, people will come in and buy them, and enough people go in and buy them, it raises the price back to an equilibrium. The price too high, nobody buys it until it gets lower, until enough people buy it, until it reaches an equilibrium. That's how markets work. There always has to be an equilibrium. Whether people are correct or not, I've never bought into the fact that everyone has all the information all the time and the prices are accurate. That's bunk. We figured that out in 2008. I think we all know that because markets are not free markets, and they're certainly not necessarily accurate because not everybody has all the information. And just as we talked about, even if they did, it doesn't mean the prices are going in the direction you think they're going. So the markets are never that simple. But if you look at the chart, you realize it's obviously at a higher point. Now, at some point, that's going to reverse. I don't know what it's going to be, why it's going to happen. It could be that all other countries decide to raise their interest rates by 2% tomorrow. Well, that would probably cause their currencies to go up and the US dollar to go down. That's an example of what would happen. It could be that we do something stupid globally and we look like idiots, which would not be the first or the last time. But that when that happens, that also could cause the dollar to drop. It could be that we decide to be financially irresponsible. Now, right now, we're on the responsible track, meaning that we're not printing money anymore. I'm not sure I buy that, but they state that we're not printing money anymore. And although if you go to the politicians, they're saying they're going to lower inflation by printing more money, which was comical. I wish I could shoot a video clip on this live stream of all the stupidity we hear from the politicians. But the point is you hear this internationally too. People are going to fix prices, they're going to do all these stupid things, and it just makes it worse. And I know they're trying to do the right thing because they don't want to get burned at the stake and people chasing after them with pitchforks. But it ends up doing the wrong thing for the economy. Now, I don't know what's going to cause this to change. I just know at some point it will. So if we keep raising interest rates against the tide of the global economy, the dollar is going to keep rising. And as we talked about in the last episode, and we'll keep reiterating, the market prices in future expectations. So people already have priced in the next 6 months. So if you think, oh, well, tomorrow this is going to happen, that's already priced in, unless it's a surprise. So you should expect the fact that what happens in the next 3 months, if the Fed's going to stop, if the Fed's going to change, that's already priced in. Now, if things change and facts change, then people obviously can change their mind and change what they think is going to happen. And of course, that causes prices to change. But in this case, here's an example. I wanted to put this picture in here, the Barron's cover, the powerful greenback. And this is why we were calling it King Dollar. And of course, you love my laser eyes on Ben Franklin there. One of the things that tends to happen is we call like the magazine indicator. Is what tends to happen is when you see something on the front page of publication, and this has happened historically. It's usually like on Newsweek or some non-financial related publication, and when it comes out with a magazine cover. It's like, oh, things are going to zero. I think there was one in 2008, which was it showed the globe and it showed like a stock chart arrow going through the bottom into space. When you see things like that, I think there was an emerging markets one that's I forget what it was. It was like a tech bulls stampeding through the yard or something like that. Whenever you see that, it's time to go the other way. It's time to be a contrarian because it's not that the news media is deliberately trying to do this, but they're not experts. They're literally taking the zeitgeist of the populace and they're saying, this is what we want to know about. So they put a magazine cover to get viewers. So when you see that, it means that everyone else is going in the wrong direction. It means it's time to fade that and do the opposite. If you did nothing else, this would actually, I believe somebody did a study that means that this would outperform the index at some level because all you have to do is just go against the crowd. I wish I had that article because it was brilliant. But I want to go through some of this and kind of illustrate some of what you asked, Barb, which is when are things going to change. So I thought this was a great chart which showed the history of the decline of the British pound. You could take this and apply that to anything. The US dollar, here's an example we mentioned relative to gold. So if gold is the static point for the last 120 years, all these other currencies, the British pound, the Japanese yen, and the dollar, have all declined significantly compared to gold. You can't see this, Barb? Oh, let me try screen sharing this again. Let me hopefully my tech or me are not screwing this up. So let's try that again. Can everyone see that? Is that better?
It took me a while to figure out where the private chat was too. I mean,
all right, we're
this
working
is my
on it.
first time on this platform, so you guys bear with us.
Yeah, bear with us. Yeah, we're just inept. So anyway, so if you're somehow not seeing this, it's going to be on the episode. We're going to have it in the show notes. It's going to be on YouTube, so you'll see it all there. So don't worry if you missed it. We'll post it. But
and
anyway,
Kirk, you are so clear in how you explain things that I feel like I'm seeing it because you're doing such a good job and going through it point by point.
well, thanks, Barb. The check's in the mail for that nice comment. So if I look at gold for the last 100 years, it hasn't changed in value. The US dollar since 1900 to 2020 is down. If you're starting at 100, it would be down 99.69%. That's how much it's declined. So basically, it's down close to 100% from where you started 120 years ago. The yen, the pound is down 99.92%. So it's not down a little bit. I mean, it's down like almost 100. And the yen is down 99.995%. So really, the currencies have become worthless over the last 120 years. Now, we talk about this in the show, how cash is always a great option. You're probably thinking, well, that's stupid. Why wouldn't I just buy gold? Yes, if you're going to hold something for the next 100 years or 1,000 years, gold has been a great protector against inflation. It has for thousands of years. Is it going to be for the next 3 months or 6 months or a year? No, we have no idea what it's going to do. It could go up or down for all sorts of reasons, but that's not why you own gold. You don't own gold because you think it's going to stay static. You own gold because you want to preserve your wealth and protect it for generations or even for the next 10 or 20 years. But the point is having cash is the same thing. You have cash as a strategic position. If the market drops 50% and you own cash, that means you can buy twice as much stock now as before because your cash did not change in value and your stock did. Now, somebody said yesterday, I saw a LinkedIn comment yesterday and how somebody said, well, yes, but cash has dropped 8% on a real perspective. I said, yeah, how much of your stock's gone down? They're down 30%. Oh yeah, on a real perspective, now they're down 38%. Right? So you looking at it real terms is kind of nonsense because inflation affects everything equally. It's better just to look at nominal terms because that's going to simplify it and make everything easier to define. Now, I want to quickly run through this because I don't want to take all the time for myself. On these charts, I put every single currency, major currency, compared to gold. And I did this to show. So if you look at the different charts, you'll see that some charts it shows gold going down. So right now the gold's going down compared to the dollar. But what that means is the dollar is going up compared to gold. Now, that in itself is it's not meaningless, but it's not enough information. Now, if I looked at every other currency and I saw gold, let's say the gold is going up, let's just flip the chart around. Let's say the US dollar compared to gold, gold is going up. And then I look at the yen, I look at the euro, I look at the pound, the Aussie, you look at all the major currencies, and I see, oh, gold is going up compared to those two. That means gold is in a strong rally. Most people don't bother to look at gold compared to other currencies. They look at compared to their own. Now, if I look at the dollar and it's going down, I'd say, oh, well, that's bad. But if I look at other currencies, not necessarily. It's mainly been going sideways for the last year. If I look at the pound, it's on the lower end, but it's basically sideways for like the last 9 months. If I look at the euro, it's definitely down, but it's in a sideways channel. The yen is actually high. It's in a channel as well, but it's on the high end. And the Canadian dollar, it's low, and the Aussie dollar, it's on the high end of a range. So if you look at all of those currencies, what can you deduce? Well, you can't deduce much because they're all over the place. But you can look at it and say, all right, is there a strong trend one way or the other? If the strong trend is down for all of them, then you know that gold is declining, and you probably shouldn't own it. If it's going up compared to all of them, you should say it's a strong trend up, and it's probably worth owning it. So it's a great indicator that I rarely see people use this, but it's one of those things. Gold price is fixed, and everything else is relative to it. It's something that you can compare currencies to as well as gold. So I want to, in the interest of time, I would like to dip into another topic here, which is, let me shut off my sharing screen so we can see Barb's beautiful face and my mediocre, acceptable face. So if you look at the CPI, let's talk about the CPI for a moment. And if you look at the CPI is broken. Barb, why don't you explain the CPI to us? I don't think people really understand inflation.
CPI stands for Consumer Price Index, and there are a whole variety of different consumer price indexes. And some of them break out food and gas, I think. I didn't review this beforehand, Kirk, so you're really kind of putting me on the spot here. But let's just keep it upper level, just very simple. CPI is used to measure inflation. They choose a basket of goods to put in a measurement, and then the government figures out how much this basket of goods costs. And when it keeps going up, they use that to compare it with a baseline level, and that's your inflation rate. And one thing I want to mention about inflation, it's not universal for everyone. So, for example, lower economically, people who earn less money are hurt by inflation more than those with higher amounts of wealth, because a greater portion of their dollars are going to their basic living expenses. Also, if you don't drive and you live in New York City and take mass transit, then you don't care about the price of gas, which is a huge contributor to our inflation rate. So we each have our own personal inflation rate. But inflation, we haven't worried about that. Oh my gosh, what is it, 15, 20 years? It's been so low that many of you that are younger, under 35, have never even experienced inflation. Now, when I was a young adult in the 1980s, we had inflation rates as measured by the CPI 10, 12, 14%. which was devastating, except at that time before interest rates were lower. Interest rates were also at 10, 12, 14%. So if you had some cash, you could invest in a money market account and get 10%. So this time is a little different. But back to your original question, Kirk, CPI measures inflation.
Well, thanks, Barb. Appreciate that. That Barberpedia in full effect here today. Um, so I want to talk a little bit about both the CPI and I also want to talk about inflation. And I think there's always this back and forth about inflation, and so I want to just kind of throw down the gauntlet here. So inflation is typically measure of monetary inflation. That is typically the textbook version of what inflation is. Is it's dictating how much money is in circulation. Um, that's the measurement, right? And what people use it to describe is the price of goods and services. Are they going up? And I can tell you those are not necessarily the same thing. Now, from a textbook and an academic standpoint, yes, you print more money, you should have more inflation. That is what should happen. But the markets and the economy are a highly complex place where that doesn't necessarily happen. If you look at the last 20 years, we printed an enormous amount of money. I think on average, about every 8 years, coincidentally with a presidential term, about every year is the monetary supply doubles. And yet, up until mid last year, we did not have high inflation. So you'd think, well, why not? We should have had high inflation. We doubled the money supply. You should have extremely high inflation, but it didn't happen. Well, that's because inflation's complex. And while we probably traditionally had inflation because they were printing money, it didn't show up in the prices of goods and services. So I like to separate out the term inflation and not have it describe. I like to use an adjective along with inflation, like monetary inflation, price inflation, asset inflation, things like that. I think it's more descriptive because it's more clear. Because if you're saying, well, we have high inflation, well, yeah, we've had high college inflation for decades. And yet the CPI was 2% for many years. Now it's 8.3, but it's still not the same as college. And as Barb said, everybody's personal inflation rate might be different. So I have this chart, which apparently the screen share is not working here on the live thing, so I'm going to share it on the website and on YouTube. But if you look at the CPI, there's a chart here of what goes into the CPI. So approximately a third goes into shelter, about 14% goes into food, about 8% goes into transportation, about 7.5% into energy, education and communication services 6%. And then it goes on and on, about 7% into medical care. So there's a breakdown of what everything is. Now, I'm not going to college. My kids aren't going to college. Is it 6% of my budget? No, it's absolutely not. Is shelter a third? I don't know. I'd have to think about it. But is energy 7.5? I don't know. I'm paying a lot for gas now. Maybe it's more. But the point is this CPI makeup is not going to necessarily mirror yours. It's going to mirror what they think the aggregate of hundreds of millions of people in our economy have overall. And that's how the CPI is calculated. Now, I point to a chart below that, which shows, actually, the chart below that shows the monthly CPI change, which makes up the annual change. But the one below that, I think, is really the important one. A lot of people say that the CPI measure is fraudulent or it's inaccurate. And I think inaccurate compared to what? Right? If they're measuring something, are they lying on their measurements? They're probably not. I mean, yeah, they might be, but I would say, given how government is like Swiss cheese, if there's bad information, it's eventually going to get out. I think what was probably more instructive is that the CPI measurement has actually changed over the last 50 years. So the original CPI metric has changed many times. I think 1980 there was it was CPI was 1980. I think there was one in about every 10 years they change it. So if you're using the 1980 metrics, then the current CPI is probably somewhere in the neighborhood of like 17%. But today's it's only 8. So, it depends what measure are you using, right? If you're using the wrong measuring tool, then you're going to get the wrong number. So if you think that the old CPI was the best metric, then yeah, then the inflation is right around 17%. If you think the newer one's better, if you're following the Federal Reserve, which I think in general the government would like lower inflation overall, which you can make the argument whether that's a good idea or not. But I think there obviously have been calculations which have tried to lower it over time, which you can see on this chart as the old inflation rate is much higher and has been for the last like 15, 20 years. So I think you just have to look at the measurement. Don't just take a number and just say, oh, this is the number. Understand the number, understand where it's coming from, what it describes. But more importantly, as long as the metric and the calculation doesn't change, then it's actually not a bad measure. Because if you say, well, look at the old measurement says prior to inflation going up, it was right around 8%, and now it's 17% or 16. So it's still an increase of approximately the same amount. So it's still a good marker, right? Is 8%. Is that true for me? It's not true for me. Mine's much higher than 8%. But I think what you're looking at is, once again, going back to Einstein, it's all relative, right? Is it going up 8% compared to where it was before, or I guess technically 6%? Okay, it's going up 6% to where it compared before. Is the other one 6%? If it's similar, it doesn't matter. It's still higher. And I think what you need to understand is, how is it relative to everything else? And that's the takeaway I would say from this is look at how things are relative to everything else. Yes, your CPI may be 20%, depending on what you're buying, but just understand the metric and what it means. Because if it goes back down to 2, which if you guys are waiting for it to go back to 2, you might be dead by then. But I think the way you should look at it is that it's going to be high for a while, and you should look: is it increasing or decreasing, and how does it impact your life? So, in the interest of time, because we're getting close to wrapping it up soon. So, Barb, we talked about a lot today. Final thoughts from you, and what should people be taking away from this conversation?
Well, we brought up a lot about inflation, asset prices, global markets, and I think the thing you want to understand is the Open Market Committee of the Federal Reserve Bank is the one that sets interest rate policy. And they use this, which is called their monetary policy, in order to try and achieve a stable economy. Their goal is 2%. And so, Kirk, I don't think it's unreasonable that at some point in the not too distant future, we may get back to 2% inflation rate. That is their goal. They are the Fed is 2% inflation, sorry. So the Fed is aggressively raising rates in order to bring down the inflation rate. And so the inflation rate is going to come down. I think what you have to understand about all of these issues, inflation, monetary policy, asset prices, they are all cyclical. Every one of them. And I really liked how you talked about asset price inflation, because we were all of us investors out there were on cloud 9 for years, a decade or so, 12 years, because our asset prices were going up, up, up. But those of you that look under the hood, look at fundamental analysis of assets, and that is the price you're paying for a dollar of earnings of a company, by all measures, asset prices experienced huge inflation. They were bound to come down. The stock market was bound to come down. The question wasn't if, the question was when and what the catalyst would be. We've now seen the multiple catalysts that have driven asset prices down. Because they are cyclical, I know now is a scary time. I've talked about the psychology of the markets. The psychology plays into almost all of these issues. I'd like to leave on a positive note, Kirk.
Please do.
asset prices are going to return. Your stock market investments will go back up. If you're dollar cost averaging in your retirement account, or if you have some cash now and are deploying it gradually back into the markets, 10, 20, 30 years, if you're young, if you're like me, you'll be
40.
dead, but at least my kids will enjoy it. your your asset values will go up. If you believe in the strength of the US and the world economies, that they will continue to prosper over the long term, what are you going to do with your money? You need to invest them in growing businesses. So, my advice is don't be spooked by inflation. Take the steps that are going to make inflation better. If you're a US consumer today, you're in luck because global goods and services are cheaper. The supply chain has reversed. And if you need to shop today, you're in a great position because anyone who has been to the store has noticed there are surpluses, which will drive prices down for a lot of goods and services. So, if we could only substitute food for clothes, we'd be in a great position. But unfortunately, everybody has to eat, and food prices are going through the roof. This is not going to continue. The only thing you can be assured of is that change will happen and that no one knows the future. But if we can use the past 100+ years, it is likely that the stock market, that the global economies will improve over time. So I piggyback on what Kirk said. Don't be afraid of cash. Those investors that were invested 90, 100% in stocks before this crash of 2020, this is kind of a wake up call for you. Even if you're young, it doesn't hurt to have a little cash to fall back on. So, I am Barbara Friedberg. You can find me almost every week. I'm a panelist on Money Tree Investing Podcast. I have a YouTube channel. I'm an expert in robo advisors. You can find me at Robo Advisor Pros. You can find me on my other website, Barbara Friedberg Personal Finance. I also write everywhere on the internet. So I am so happy to be here chatting with you guys. Feel free to contact me with any questions you might have. Kirk, thanks for bringing me on. And you guys keep calm, keep cool. Everything's going to get better.
Great. Well, thanks again for joining us, Barb, and bringing your sunshine to an otherwise cloudy Friday. So thank you very much for joining us. And just to kind of wrap it up, I'm gonna leave on a high note because it's Friday, and maybe we'll have gloomy Mondays or something. We'll talk about more reality, but I think it's Friday, and we all want to end on a high note. So I'll just say this: that Barb's correct that things go up and down. If you listen to the show long enough, our perspective on inflation. I think it's a structural inflation change, and I think that's going to impact things in a major way. It doesn't mean things are going to go up forever. It doesn't mean they're going to go high forever. It just means that things are going to be different than what you've expected before. I do want to point out one point that you made, Barb, which is the Federal Reserve has a 2% inflation target. Inflation target. So I think what's funny about that is I've looked, other people have looked. Nobody can figure out where that 2% came from. It's almost like they just pulled it out of thin air and said, "Oh, 2%. That looks like a good number." So
I think it's because it seems reasonable. That would be my intuitive guess, but I have no data to support where the number actually came from either.
Right. And that's relative to where we were at the time. So they thought, oh, 2 is a good percent because it's low. I mean, ultimately, what the Fed and the politicians want is low inflation, not negative, but low. So it helps boost economic prices because they want stability. And they thought they had it until COVID and the fact that eventually this was going to happen anyway. But and what ended up happening was now we have high inflation and now we've got serious problems on our hands. So I think what you should keep in mind is that you need to be flexible in your thinking. You need to always have an open mind because, as Barb said, we don't know the future. We don't even know why things happen half the times. And this isn't me, this is everybody. Despite the fact that people are out saying this is why it happened, they don't know. they're speculating, right? We all speculate on why things happen in life. And I think if you have more of an open mindset about it, that you're, I'm trying to remember who said this, the unknown unknowns, right? You don't always know what's going to happen, but you should be flexible enough in your thinking that you can adapt. What we're experiencing and going to experience, in my opinion, for the next 5 to 10 years is an environment which is going to require you to be adaptable. If you're not adaptable, you're going to be punished in this environment because things are going to be volatile. There are going to be lots of change economically in the markets. And if you're adaptable, you'll be okay. If you're not adaptable, then you could be in serious trouble. And I think people just need to be aware of that, not because we're trying to scare the pants off you, but because if you're aware, you can prepare. And that's really the key is once what we're trying to do here is we're trying to prepare you intellectually, mentally, psychologically for good and bad conditions. If you want to be successful and create and protect your wealth, you need to be adaptable and you need to be mentally prepared for what is going to potentially happen in the future. So we're going to wrap it up here. So that's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app if you're choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to our show notes, resources, and archive shows. Also, we're now on YouTube. Obviously, we're on LinkedIn because that's where you're seeing us today, but we're also on YouTube. Check out our YouTube channel. While you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think. We're merely telling you how to think about investing. We're not selling you any products or services, and do not consider this advice. If you have any problems with the show, I blame Putin. So please call him directly and express your feelings. If you're seeking financial advice, talk to a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. So have a great week ahead. And remember, no one will care about your money like you do. So invest in your life. Now, those of you who are still sticking around, I'm going to try to share my screen. If you want that, I can show you some of the graphs. Otherwise, you can see it on the podcast. Nope, I cannot see the button. So we're going to end it there. Okay, thanks, everyone. Wrapping it up.